I'm starting today with a breaking story about oranges. Hardly a traded commodity in the true sense, but a livelihood nevertheless for about 2,000 Australian farmers. Frank McCurry is an orange grower from near Leeton in southern New South Wales. He's also part owner and operator of a packing shed for 50 other growers. In a normal year, he would get $50 a tonne for his oranges. This year, the price is zip. He can't even give them away. The processors don't even want them for free. So this is what's happening. The oranges are being dumped. 30 tonnes a day will be left in the paddocks for the cattle and to rot in the winter sun. The fundamental reason is the very cheap importation of orange juice concentrate from Brazil, and Australian oranges just can't compete. Yet Frank McCurry is not bitter, he just doesn't understand why.
If we squeezed every orange that's grown in Australia, about 450,000 tonne annually, we still wouldn't have enough for Australia's own needs for the juice. And we're still allowing the Brazilian stuff to come in.
I'm told there'll be several thousand tonnes of oranges dumped over the next few weeks. Some might call that economic reality. To me, it looks like appalling waste. Moving on now to wool, because it's the Australian commodity which has probably suffered most from the recent economic dramas unfolding in Europe. Here's a graph of the key index. It's the Eastern Market Indicator. And you can see there's been a bit of a roller coaster road, like most commodities. Big peak here, this is last year, and then this marked slump and still going down, now at about 1,050 cents a kg. In historical terms, not too bad, but way down, in fact, a dump of close to 500 cents a kilo from the peak in the early months of last year. Sounds and looks bad, doesn't it? But when I spoke to wool analyst Chris Wilcox, he said the outlook for the industry remains positive.
I think it can be very confident about its medium-term to long-term future, Kerry. That's certainly the key messages that were coming out of the International Wool Textiles Organisation's annual Congress in May. But the short term is being hurt by the uncertainty and volatility coming out of Europe.
So, Chris, it's the broader macroeconomic conditions which are impacting on prices rather than anything specific about wool.
Oh, absolutely. It's we're seeing real uncertainty amongst the wool textile industries in China, in India, in Europe itself, and they're being very cautious about their buying. And part of that is because they're seeing orders coming out of retailers, out of Europe in particular, are being quite slow for the coming autumn-winter.
And what about the competition for wool relatively? How is cotton travelling, for example?
Well, cotton's seeing the same kind of problems. In fact, if anything, they're seeing it worse. Wool prices have fallen by about 13% in US dollar terms since April. Cotton prices have fallen by almost 20%. And year on year, cotton prices are well under half of what they were 12 months ago. Wool is only down by about 25%, better quarter.
So your message for producers is hang in for the moment, hang tough. Things will be all right in the long term.
Well, yeah, that's right. And as I said, the messages coming out of the IWTO's Congress in New York in May was much more positive in the medium term. There's much more interest amongst retailers and wool processors in the use of wool in clothing and in interior textiles. There's a lot of enthusiasm about that, about the stories about wool and about conveying those to consumers. So I think the medium term, it's bright, but the shorter term, like many other commodities and like the equities markets, are facing the really tough times as a result of Europe.
Chris Wilcox, always good to have you on Landline. Thanks for your time today.
Thanks, Kerry. Bye-bye.
Checking the auctions last week, and as mentioned earlier, brokers blame the uncertain macroeconomic conditions for another price slump. The Eurozone, the Greek elections and the overall impact on confidence, it's all having an impact. The lift in our dollar didn't help either, so the Eastern Market Indicator closed at 1,054 cents a kilo, down 2.3%. Now, another market which retreated last week was cattle. Recent heavy rain in the east and to an extent in the west, certainly last week, has caused a lot of disruption getting cattle out of paddocks, and many producers are now playing catch-up. So overall numbers were up despite the shorter trading week. Most of these prices are giving up some of the gains from the previous week, and quality was plain, although some better cattle could be found in the north. And despite the falls in the sale yard, the Eastern Market Indicator had another slight lift, closing the week at $3.74 a kg. In the far north, the anxiety levels are climbing by the day as the September quota figures for Indonesia get closer. Rumours and conspiracy theories can be found in every bar, from Kununurra to Cairns. Prices steady for the moment. The Ocean Drover left Darwin last week with big numbers, the absolute last of the June quota. Lamb numbers were again down last week. In Western Australia, numbers so far this year are 55% below the 2011 figure. Not quite so bad in the east. And as usual for this time of year, quality is a major issue. So lambs went up and mutton slipped. The sheep price is $1.40 down on this week last year. Turning now to grains, where the news is mostly negative. Again, the macro climate is weighing heavily, especially in Chicago, where the soybean market copped a whack despite some extraordinary export figures out of America. More than 1 million tonnes shipped out in just 1 week, most of it, of course, headed to China. Weather concerns held up the corn price, but wheat and soybeans headed south. There's quite a bit of what traders call fund liquidation going on at present. Local futures were soft on the back of some handy rain, almost too late in the west, but a lifesaver too for many growers. So WA wheat shed $6 and wheat in the east was off a fraction. Spot prices are also down. The weather concerns are a long way from over in the west, but eastern states growers, those in Victoria and the south of New South Wales, are now extremely worried they need rain fast. But for the moment, here are the prices on offer. Canola losing $20 would be a bit of a surprise. New York now, and cotton futures for the nearby July contract had a major jump because good exports and short sellers. Quite a difference, isn't it, just for 7 days? It's worth pointing out the further out December delivery for cotton stayed close to 70 cents a pound. Meanwhile, sugar continues to ease. And that's the Landline check on price.